Hi, my name's Jeff. Welcome to the Saward Dawson webinar on AASB 16 leases, where I'm going to go through some of the practical application of the new accounting standard. I'll start with a bit of background information as well. So this presentation is designed for those people as they get started in what the new lease standard will look like for them. So let's get started. So first of all, there's a couple of other webinars that will be up on the Saward Dawson website. So there's a broader financial reporting update as at June 2018, as well as really getting into the complexity of the new revenue standard, which is AASB 15. If you're looking to access those, George's email address is on the bottom of this slide. So get in contact with her and she can point you in the right direction if you're looking for this information. On that, you can also contact Georgia if you'd like a copy of the presentation in PDF, or if you'd like a lease assessment sheet, which we'll talk about later in this presentation, which helps clients or helps people assess their leases to understand what is the likely impact under this new standard. Obviously, this presentation is really general in nature and not specific advice, so I encourage you to read the relevant disclaimer. I'll skip through that. So today I'm going to talk about when the effective dates are, what are the requirements of the new standard, its application to NFPs and its interaction with the new revenue standard or contribution standard, which is AASB 1058 for not-for-profits. What are the transitional rules and what types of disclosures you will need to complete to comply with AASB 16 in your financial report. I'll also go through some examples and answer some previous questions throughout this presentation on these slides. So bear with me and we'll make a start. AASB 16 is one of a number of new accounting standards that have been released over a period of time by the AASB, and they're referred to often as the next wave of accounting standards. They have a significant impact on some of our clients and some organisations, hence this presentation. The main changes are the three accounting standards which you can see on this slide. So financial instruments standard, the revenue standard and the leases standard are all coming into effect in the relatively near future. All of them have application dates beginning for periods beginning 1 January and then the relevant year. And so this diagram attempts to show you when your comparative period is likely to be and your application date. So if we look at leases in particular, when's the new standard effective? Well, it's effective for periods beginning on or after 1 January 2019. So what does that mean? If you're a December year end, you'll be effective, or your first financial report that will need to comply with leases is the 31 December 2019 financial report. If you're a June year end, then you'll need to comply at 30 June 2020. What is the major change in the leases standard? In effect, it's to bring what is currently operating leases, including property leases, onto your balance sheet, other than if those leases are less than 12 months old or they're minor leases. A minor lease, for example, would be a laptop. A motor vehicle, for example, would not be considered minor, and so they would need to be brought onto the balance sheet. What's the impact of the new standard, or what are the impacts of this? In the initial period of a lease, it's likely to be a higher expense than what you initially record under the current standard as an operating lease payment. And that is because there's a financing component assumed within the lease. So therefore you get a higher interest expense at the beginning, and as you pay down the principal, it becomes lower. There's a significant change in your balance sheet. We're likely to see large new assets and liabilities on our balance sheets in relation to what were previously operating leases and not recorded on the balance sheet. The impact of that is it will impact any metrics that you use around the financial report. So this could be an improved cash flow from operations, because operating lease payments used to be in cash flows from operations section of your cash flow, will now be in the interest and principal reduction section. And there's increased complexity and ongoing calculations required under this standard, even for existing leases or where you're maintaining a lease. So let me take you through a basic example to illustrate how this new standard will affect many, many businesses. So if we have currently have a lease and we enter into a lease agreement on 1 July to lease a building for, that's cut off for 7 years at a total of $450 per year. That means you've got total payments under that lease of $3,100. Part of the calculation is to work out what discounted or the implied interest component is in the lease. And for this example, we're saying the entity could go and borrow money and acquire this building for 5%. And that's called the incremental borrowing rate for the organisation. To do a calculation, therefore, on the initial entry that would be required at the date of entering into the lease, we simply do a cash flow, a discounted cash flow model or calculation, which is 7 periods, a $450 period, discount that back at 5%. If you do that calculation, you end up with approximately $2,600. So on initially entering into the lease, an entity would record a right to use asset, being the right to use that lease property over 7 years for $2,600, and a lease liability for $2,600. At the end of year one, we look at that calculation. We treat the right to use asset the same as you would a piece of other plant and equipment or a leasehold improvement or an intangible asset that's amortized. And we calculate an amortization expense. Typically, amortization on these type of assets would be recorded on a straight line basis because the entity receives the benefit fairly evenly over the 7-year period, presumably. And so you'd have an amortization expense of $371, and you would reduce your right to use asset by the same amount. We then look at the financing side or the liability side, and based on a calculation of the lease liability, just similar to what you would do with a finance lease at the moment, you'd calculate interest expense on the principal would be $130. Your principal reduction or reduction to the lease liability would be $320. And obviously throughout the period, you've paid that $450 of lease payments. So you can see in year one, you actually have an expense of $501. Under the current standard or your current treatment, you would have an expense of $450. So this example illustrates the case where you get additional upfront expense at the beginning of the lease, and at the end of the lease, it would be less as that financing component becomes less throughout the period. Similar to your current mortgage on your house, etc., where you reduce the principal, your interest amounts are reducing as well. So that demonstrates a basic example. I'll now maybe unpack some more of the detail of the lease standard. So first of all, what is a lease and what is included in the standard? So a lease is a contract that contains a lease or conveys a right to control or use an asset for a period of time in exchange for consideration. There is some small amounts of complexity in certain areas around this, but pretty much you really should know when you have a lease agreement or not. If you're uncertain, you can delve into what a lease contract is, and that's further defined in the standard. However, we don't expect too many issues from most organisations. There are a couple of scope exclusions, however, from the standard. So leases in relation to biological assets. Biological assets means things that are alive or growing, so plants, animals, those sort of things. Or where you have a license or a royalty arrangement for intellectual property. So a license to use intellectual property is not covered by this standard. It's accounted for separately. So what are some of the complexities and judgments regarding leases? First of all, what is a lease payment? What is the lease term? And what discount rate do we use? I'll go through some of the issues for each of those. So the lease term. Leases often have options or uncertain lengths of time. And therefore, when we're calculating the initial lease asset or right to use asset and lease liability, we need to know what the lease term is under the standard. So the lease term is the non-cancelable period, so the period you've initially contracted for, plus an option to renew if it's reasonably certain that you will extend that lease or exercise your option. Periods after an optional termination date, and it includes the rent-free periods if you get rent-free at the beginning or at the end. When you're working out what the likelihood of renewing your option is, you would consider the economic incentive to exercise or forfeit the option. And however, you would not consider the lessor's option to actually terminate the lease. You would ignore that in your calculation or assessment of the lease term. So, for example, if you were leasing a factory where you had incurred significant costs in installing plant and equipment or other types of items, you then have an economic incentive really to renew those options at least to the end of the useful life of that plant. And so in that case, you would look to, when calculating or determining your lease terms, it's likely you would include the options to extend or the options to renew that lease. If you didn't have economic incentive, or in fact if there was economic disincentive to extend, you would not include the option periods included in the lease contract. Lease payments also can have variability about them. So what would you include in the lease payments when you're doing the initial lease calculation? You include fixed payments, or where they're in substance fixed, less any lease incentives receivable. So what's the net amount you're fixed into paying under the agreement? You would include any variable payments that depend on an index or rate. In Australia, often there's a CPI adjustment included in a lease agreement, and so those variable payments would be included because they're only subject to an index or rate. And you include any residual value guarantees. This is similar to the balloon payment you currently have under a finance lease. And the same with the purchase option payments if you're expected to exercise. So any of those items would be included in the lease payments and therefore impact the value of your opening lease liability and your right to use asset. Items that aren't included would be where your lease payment is fully variable. For example, many retail premises leases have a percentage of sales type calculation within them, where you increase your sales above a threshold, there's additional lease payments calculated. Because they are fully variable and do not relate to an index or rate, you would exclude those. Similar, any variable amount or other variable amount that doesn't depend on an index or rate. You expense that variable amount as you incur it. So if you go over the sales threshold in a retail lease and there's an extra lease amount payable, you expense that as incurred. Let's go through an example with CPI included and what the impact of that is. Now remember, your payment that is based on a rate, so if I go back to the previous slide, if you have a variable payment that's dependent on an index or a rate, this is a CPI payment, okay, or CPI example. So let's take my original example, which calculated $2,600 right to use asset and $2,600 right to use liability based on $450 payments over 7 years. If after year one, we say that CPI is increased by 4%, so our annual payments will now increase by 4%. So I have 6 years remaining, but my minimum payment is now going to be $468 because of the CPI adjustment. At the end of year one, I need to go back and recalculate my lease liability and my asset because of these additional payments. So in this case, if I recalculate it, I increase my right to use asset by $91 and I increase my liability by $91 also. In that case, I've still used the same 5% discount rate to perform that calculation. So if you have a lease with a CPI adjustment, your amortization and your interest expense is going to change for the following period and each period where that adjustment is made. And you need to do a similar adjustment every year to recalculate your liability and your right to use asset. So this becomes a rather onerous obligation if you have a significant number of leases, or even for an individual lease where you have to go back and do that recalculation. This is the accounting standard extract, which explains what a lease payment is and when you should remeasure that lease payment in relation to an index or rate. Similarly, for the lease discount, again, there's complexity around what is the discount rate that you should use in calculating your lease liability and right to use asset. In my case, or my example, I used a 5% rate. Not always 5%, obviously. So first of all, your discount rate will be based on if the rate is implicit in the lease, you would use that. Many finance leases for items such as motor vehicles, etc., the rate is actually implicit in the lease because you know the actual value of the asset you're purchasing. For example, if you could buy a car for $30,000 and your total lease payments are $38,000, you know your expense and you can do a calculation to work out the interest rate, or the rate would actually be stated in your lease agreement. If that's not the case, which it wouldn't be for example, in my example, which was a property lease, you need to understand or calculate what your incremental borrowing rate is. For an asset, this incremental borrowing assumes that you're going to acquire that asset on a similar term, security and economic environment on the date you entered into the lease. So this would be simple if you're an organisation that currently has bank debt in around certain secured assets. However, if you don't have that example, you would need to go and understand and look at the market to determine what a usual rate is for example, a commercial property if you're going to buy one. What sort of financing would you currently be able to achieve in your organisation for that type of asset based on a similar term, security and economic environment? Your discount rate only changes where their lease payments change as a result of variable rates. This is quite unusual. Or your lease term changes, or there's assessment of the exercise of the purchase option changes when you were working. Again, that was one of the items that was included in the lease payment. So if you change what your assessment is on that, you would need to adjust that for the discount rate. In my example, where I was just making adjustments on CPI, that does not affect the discount rate you use. In most cases, you will simply use the discount rate that's appropriate at the beginning of the lease, unless one of those three items occurs. So what are some of the issues with lease discount rates? Well, if you don't have existing borrowings, you need to go to the market and try and achieve that. That is difficult for organisations. One, it's costly to do and they have to do research, but there are some organisations where it would be unlikely that a bank or a typical financier would lend you money to buy a property, etc., because you don't necessarily have the underlying profitability of cash flows to obtain a borrowing. When we're transitioning, there is a calculation of leases on opening balance sheets, and therefore what rate should you use for those historic leases? There are a couple of the issues. The right to use asset, how do we measure that? In my example, it was simply the same as the lease liability to begin with. However, it can be adjusted for other items. These would include indirect costs. So for example, it may be legal fees in entering into a lease, or other items that would include similar to PPE, which is property, plant, equipment. It's the cost to remove or restore, again, similar to PPE and required under AASB 137. You would reduce it by incentives received. So if you receive incentives, upfront incentives around a payment or a reduction in lease liability or lease payments, you would take those off your lease liability. We're measuring the right to use asset. Typically, you would measure it at cost, similar to PPE. However, you could use a revaluation model, similar to investment properties or PPE. I think that would be unlikely, but it is possible. depreciation and amortisation rules still apply. So typically you would see straight line or unit of use type measure around these right to use assets. Again, if it was a property, you receive the benefit or utilise the benefit really on a consistent basis across the lease period. So I'd expect that straight line depreciation and amortisation would be appropriate for most right to use assets. And like all assets, they are subject to impairment and would likely be allocated to a CGU or cash generating unit under AASB 136. So the impairment rules would apply. It is a separate, many questions are around, should it be a separate asset category? Is it included in PPE or is it an intangible? The answer is that we expect that it will be shown as a separate asset on the balance sheet. It is a separate asset category under the accounting standards, and accordingly we expect that the right to use asset will be shown separately. There's an annual reassessment of the lease term if circumstances change that impact the likelihood of exercising an option. So if you have an assessment where you thought it was highly likely that you would exercise your option, but then something changes, you need to then reassess your lease term and therefore would recalculate your lease liability and your right to use asset if that was the case. Recalculations based on market rent reviews. Rent reviews are ignored in the initial calculations. You do not make an estimate of what you think the increase might be. What you do is you ignore that and you wait for the rent review to occur, and then you recalculate the asset and liability when it occurs. That is because a market rent review change is a variable amount which isn't dependent on an index or rate. Accordingly, it doesn't qualify in your initial calculation of your lease payments. However, once it occurs, it obviously then becomes part of your lease payments, and again, you do a recalculation. So what are the main impacts? Obviously, it results in amortisation and interest in your P&L and the front ending of that expense. At the moment, we're used to seeing operating lease payments or something like that as an expense. We'll now see amortisation and interest once this standard is effective. In the cash flow, you'll see repayments of borrowings and finance costs. You'll see higher assets and liabilities on the balance sheet, and your current ratio and other ratios included in those used in bank covenants will be impacted. Accordingly, if you have items like EBITDA, for example, you will now have a higher level of interest and a higher level of amortisation, and so you're likely to see your EBITDA number increase compared to where your operating lease payments are actually included within EBITDA. Interest and amortisation is excluded and therefore, or added back, therefore a higher EBITDA number. So I would expect the banks will start to understand this and amend their covenants accordingly. If you're impacted the other way as a result of this and you have a higher front ending of expenses, but your covenant is based on net profit, for example, you may want to, or I would advise you to, approach the bank and get an adjustment to your covenants before you reach them, hopefully in the year before you actually commence any sort of agreement. I'm now going to move on to the interaction with the not-for-profit standard, or AASB 1058, which is income for not-for-profits. If you're not a not-for-profit, you may want to skip through this or get a cup of coffee and come back where I'll talk about transition and disclosures shortly. But there's some interesting impacts in the not-for-profit space. So the recording of a lease which is significantly below market terms or conditions, these might be commonly referred to as peppercorn leases, at the inception are principally enabled to enable an entity performance objectives. So if you're an entity, a charity, for example, that receives the right to occupy property and you use it to fulfill your objectives as a charity for, let's say, $1, you are now required under AASB 1058, when that becomes effective, to measure that right to use asset at fair value. This could result in significant profit volatility and compliance costs for not-for-profits where they have these peppercorn or significantly below market value leases. I will give you an example. On 1 July, let's say, a donor agrees to provide a charity with the use of a building for 5 years at $1 per year. This would be a common peppercorn lease scenario. In this case, the market value of my rent is $100,000 per year. In the table, I've simply removed the thousands. So in year 1, I've received the right to this property, to use this property. I've ignored discountings in my calculation, but in effect, I've received rent-free for 5 years, which would have cost me, if I had to go to the market and rent this property, $500,000. So I've received that benefit up front. This means I record income in year 1 of $500,000. I'm assuming this was at the start of the year, and so my amortization would be spread over the 5 years, would be $100,000 per year. And so in year 1 on this table, you can see that I have income of $500,000, amortization expense of $100,000. Therefore, my profit for the year will be increased by $400,000 in year 1. However, in years 2 to 5, obviously I've recorded all my income up front, but I still have the amortization of that asset to account for. And therefore, I'm going to record a $100,000 expense every year and have that same profit impact. So this results, the impact of this is significant profit volatility and compliance costs in calculating these amounts. Obviously, this is a simple example where there was judgment around the market value. So where such an asset has been given, but you don't know what it would be worth to lease it, where the lease term is uncertain, there may be options for a not-for-profit. If I'm calculating a long-term peppercorn lease, what discount rate would be appropriate for that? All needs to be considered to do those calculations, similar to the example I provided before with the discounting calculation. A second complexity to think about is many not-for-profits have a group structure. So for example, there may be a church as a charity that owns a school property, for example, and it chooses to lease that property to a school which it controls, and it controls the board of, for example. In this case, that initial contribution being the right to lease that property for $1 a year, that's significantly below market value, would be a transaction with owner. And therefore, the initial 500 would be an equity transaction straight to the equity section of the balance sheet. However, you would still have the amortization. So in this scenario, I still have the additional $100,000 expense every year, but I never have the income. There are a few things that we can think about as to whether that is always the treatment. There's a separate webinar in relation to the new AASB 15 and the not-for-profit impact of that. One of those is if you meet what's called the sufficiently specific and enforceability criteria, it could result in the deferral of the initial income to align with when you fulfill your obligations. A lease could be included in those types of contracts. Therefore, if the lease contained criteria, for example, I'll go back to my school example where you must perform a certain education and have certain numbers of students, and you have criteria around the lease where the school only gets to lease the property if it meets these certain criteria, and they would meet the sufficiently specific and enforceability test, then the revenue would actually be deferred and recognised over the period. Therefore, you would likely get matching of income expenses. This doesn't really help the parent entity example, as it would still remain an equity contribution. So what do we see, or what have we been speaking to some of our clients about? Where you have a friendly lessor, or you get on well with them, for example, you may seek to actually renegotiate your lease. So if you've got a peppercorn lease and you're happy to go back to your lessor and renegotiate that, you could include sufficiently specific and enforceable criteria within that lease and therefore get you matching of the revenue expense. Alternatively, you could seek to make the lease so restrictive that nobody else would want to come in and pay money to meet those criteria or take over that lease based on those restrictions. What this would mean is this would result in the fair value of that lease reducing significantly, and therefore it would have such a low fair value that perhaps a $1 lease in effect is the fair value when you take into account those very restrictive terms and conditions that the lease includes. This is quite a technical area, so if you were looking to do that, I would suggest you speak to one of your accounting advisors or speak to us at Saward. So for the not-for-profits, please welcome back to the conversation. Sorry, the for-profits, welcome back to the conversation. I'm about to go through the transition period. Transition just simply means when you move from applying the old accounting standard to the new AASB 16. So there's a choice of retrospective and modified retrospective approach. So the modified retrospective approach is for previous operating leases, you could calculate your right to use asset as if AASB 16 had always applied, or you could simply calculate what your lease liability is and make that the equal amount. If you think about what that's saying is you could go back and calculate the lease from the beginning of the lease term or the lease period. You would then amortize that, presumably straight line, and therefore come up with a right to use asset calculation and number. Or you could simply choose to match it to the lease liability. The lease liability under the modified retrospective approach, or under most approaches really, is the present value of the remaining lease payments at the current incremental borrowing rate. So you could choose to use the incremental borrowing rate at the time of transition to the lease standard, rather than going back, say, 10 years when the lease was first entered into and looking and trying to get evidence as to what the incremental borrowing rate would have been at that point in time. I think that's a significant concession for perhaps particularly not-for-profits with long-term leases or peppercorn leases. Many of those are 99-year type lease arrangements. The modified retrospective approach for previous finance leases, again, the page before was for previous operating leases. For previous finance leases, you simply pick up what you were doing already. The finance lease calculation and the way it has been treated historically is very similar to the current AASB 16, and therefore you just carry on with what you were doing already. You will classify amounts perhaps out of leasehold improvements within PPE and put them to the right to use asset category within your balance sheet. There are some practical expediences on transition. So these are aimed to make things a little bit easier, where we're going back using a whole lot of judgment doesn't really make any difference and is not worth the effort. So if, for example, the remaining period of the lease is less than 12 months, you can choose to treat that as a short-term lease. Remember, leases less than 12 months under AASB 16 are excluded, and you just expense the payments as they incurred. Therefore, even though you may have had a lease that's been going for 10 years, if on transition that's about to finish within the next year, you can treat it as an operating lease in effect for the last year. You can also use hindsight in determining the lease term. So you don't have to go back 10 years ago again and work out what would you or have likely done with the option period, etc. If you've renewed, if you're likely to renew, and you can look at in effect, the benefit of hindsight to determine the lease term. In relation to retrospective approach on transition, typically when you change an accounting policy or there's a change in the accounting standard, you retrospectively apply that. That means you change your comparative in accordance with the accounting standard requirements under AASB. There is an option where in this standard, first of all, you can do that where you go back, calculate your comparative and amend it in accordance with AASB. Or you can change the current year only. This means you don't change your comparative period and you recognise the impact on transition in your opening balance of retained earnings in the current year. This This approach is quite a concession, but it does require certain disclosures around, in effect, what your expenses and what would have been had you carried on under the existing standard, to give it some comparability to readers. Disclosure also increases in relation to AASB 16 and your leases. Where it's most important is where there's variable components. So you look at the additions of the right to use assets. So similar to plant and equipment, there's a reconciliation type disclosure which includes the additions of the right to use asset. You include the disclosure where low value or short-term exemption is required. So how much of those lease payments that didn't meet the category of the lease because they were less than 12 months or they were considered? There's a maturity analysis for liabilities, which is currently called under AASB 7, which talks about the terms of your liabilities, and there's a disclosure around that. Your interest expense on the lease needs to be disclosed, and your expense from variable lease components, for example, where I talked about lease payments that are linked to level of sales in a retail lease arrangement, they are also just required to be disclosed. It's even more extensive disclosures than that if you're doing, in effect, full GP. RDR, those people reporting under reduced disclosure, they have really the ones I've listed here. Full GP, there's significantly more disclosures, particularly around the areas of estimation. That brings us to the end of AASB 16 webinar. There is a financial reporting update also on our website, which goes through some of the other regulatory changes, gives you a high-level understanding of 15, 16, AASB 9, and what's happening around the financial reporting environment, particularly in relation to special purpose. If you're interested in that and you can't find us on our website, please contact Georgia. Her email address is down below. Otherwise, if you have any technical questions, etc., please don't hesitate to contact me. There's also a detailed webinar likely to be posted up in July 2018 as well around AASB 15 and the complexities associated with the new revenue standard. I hope you've enjoyed this webinar. Again, thank you very much for attending. And please don't hesitate to contact Saward Dawson if we could assist with your financial reporting.